Okay, folks, so welcome to 2015 and the Contrarian Trader market forecast as we proceed into the new year. Before I get to the charts that I'm going to go over, I want to point out the corruption. During the time where we were all focusing on the holidays, spending time with our families, the banking sector for quite some time, namely led by JP Morgan and Citigroup, helped gut whatever good provisions there were in the Dodd-Frank bill. In short, the limitations that Dodd-Frank put on the banks were gutted. The American people were sold out, not by Democrats, but by Democrats and Republicans, both. The only two elements of each party to stand up and fight this were the far left and the far right. And I can't believe I'm saying I agree with both of them. What the banks successfully did was put themselves back into a position where they were in 2005 when they were making high-risk bets on the market. And now what our federal government did, they allowed the banks to use FDIC deposit money, your money which sits in your bank account, to be traded by the banks. It's a free loan to the banks, and if they fail, if they lose on that investment, guess who's got to pony up the money? The FDIC and the Treasury to help bail out the banks when once again they get into trouble. And they said back in 2008 the banks are too big to fail. Well, guess what? They're bigger now than they were then. It's because there are fewer of them. So when I see the corruption that there is in Washington, and how once again the banks, who are supposed to be the smartest guys in the room, until of course they're wrong, they are all back in a position to once again completely F up this market. Well, folks, I have to start looking to the bear camp. And I've been vocal about this. You can check out my videos on my blog, on Twitter, on StockTwits, and I stand by it. Let's take a look at the chart in front of you. We have the world stock market in green. We have 2015 GDP growth. We have 2014 GDP growth. You can see that there is an absolute divergence where we have the world stock markets proceeding higher on the back of QE. Out of all the coordinated measures and efforts by the central banks, you have global GDP growth falling off of a cliff. So what does this tell you, this divergence? It tells you that while, yes, the central banks are successful in printing money and pumping up the world stock markets, they are doing nothing and, in fact, hurting world GDP growth because of all the debt. Let's get to the charts. Okay, I am a huge proponent of stock charts, technical analysis. I am a member of the Market Technicians Association, a proud member. I am a firm believer that the stock charts will help guide you through any market. And when I take a look at charts as I just showed you about a divergence in the world stock markets and GDP versus GDP, I take a look at the Baltic Dry Sea Index for confirmation. And for those who are not familiar with the Baltic Dry Sea Index, it is the pricing power of dry bulk shippers. Their ability to raise rates to ship goods from China to the U.S. and vice versa, how little we ship to China. And you can see that while we bottomed out back in 2012, and we have had some rallies since that point in time, we are back down to trading not all that far away, a couple of hundred points from the lows seen back in 2012. So what this tells me is that this is an accurate depiction of global GDP. The inability of shippers to raise rates. And when are they able to raise rates? It's when there's demand in the overall marketplace, in the global economy. And they can't. We are trading near the lows of 2012 while the stock markets are trading at all-time highs. Now, the FX side. This is the iShares FTSE China 25 Index Fund. This chart here is a monthly chart. You could see back in July, we broke out of this long-term pennant formation, a very powerful move higher, and we are now flirting with a resistance level at 42.03. If we break out, it will be because of the QE measures that China has adopted, and you could expect their stock market to rally. Why is that a negative for the U.S. stock market? It's because the money that was flowing into the U.S. stock market can be diverted now into a new bull rally over in China. Now, what if this fails? What if this breakout fails? What if this breakout above 42.03 doesn't happen? It reverses and breaks back down into this trading channel. What that would be is a breakout point failure. All of my members realize that I view that as one of the most bearish events that could possibly happen. And if we do break down into this prior pennant formation, we are probably going to test this lower band here, and we could quite very well fail and break down below this lower band. That would signal a significant slowdown in China and probably the real estate and banking industries, all the problems they have there, coming to the forefront and having a negative impact on the global economy. They're that big now. So China is a double-edged sword right now for the U.S. stock market, which is at all-time highs. And I'll tell you why the U.S. stock market looks destabilized right now, despite the fact that you have all the talking heads on the financial media screaming that the U.S. stock market is heading higher because of multiple expansion, because of the small investor coming back into the stock market, not because of earnings growth, but because of multiple expansion and the small investor coming back into the stock market. Those two latter reasons for a stock market to rally usually comes at the last leg of a bull run. That's when the small investor gets socked right in the chin. So let's get on to the charts of the U.S. markets and the U.S. dollar. Let's begin with the U.S. dollar. U.S. dollar has had a huge 2014, and 2015 is looking quite strong as well. This is a weekly chart. We are expecting in 2014 a bias to the upside on the U.S. dollar. Short term, though, I think that we are going to see some weakness as we hit the upper band of the rising uptrend channel. And what I will be discussing with members on my weekend commentary, which is scheduled to go out today, which is the market pulse check, where we review the health of the overall markets, and tomorrow, the focus stock analysis video, where we review our watch stocks as well as our holdings. I'm going to review the impact of the U.S. dollar, where I think it's going to head short term, and what our opportunities are, and when we want to get involved with those opportunities. Now, if you have a rallying U.S. dollar that's at the upper band of the rising uptrend channel on a weekly chart, you need to take a look at what is impacted by a strong U.S. dollar. It's commodities. Commodities have gotten hit on the chin. Overlaid here in black is the U.S. dollar. As the U.S. dollar rallies, commodities get slaughtered. You can see that RSI on a weekly basis is at 9. Very attractive. This is one of our top trades for early 2015. I believe there's going to be a massive short squeeze in the commodity space and a correction in the U.S. dollar. The Dow Jones Industrial Average. We had a 17,500 price point, a target on the Dow Jones Industrial Average. Not only did we hit it, we broke out above it. Now the question is, do we stay here? To appreciate whether or not we could do that, we need to take a look at the U.S. dollar. Remember that a good portion of our multinational earnings comes from overseas sales. Now, a strong U.S. dollar makes our goods more expensive. Therefore, it puts pressure on earnings of the multinationals here in the U.S. And what I want to point out is that the RSI, since August of 2013, has been in a downtrend while the Dow Jones Industrial Average has been in an uptrend. It's a classic case of why you should not solely trade based off of an oscillator. But once you start seeing price action begin to trade along with the oscillator, you need to pay heed. And what we're seeing now is a lower high on RSI and a possible breakdown below this breakout point seen in October. Note how we broke out in October above this downtrend line, rallied. We broke down with the market, so we had price confirming the move down. Then we broke out on the Dow Jones. We are now breaking down once again on a weekly chart, lower high on RSI, while the Dow Jones Industrial Average just made an all-time high only 2 weeks ago. The 10-year yield. We had the Federal Reserve claim that they stopped buying bonds. They ended QE. So one would have expected that the demand for treasuries would have subsided and yields would have rallied. But that hasn't happened. What you're seeing is money floating in from other areas of the globe on a global slowdown, due to a global slowdown, and forcing yields lower. Now, the question I have is that with GDP for the third quarter that just rolled in at 5%, the third revision, 5%, with money floating into the U.S. bond market, why is it that the Federal Reserve cannot raise rates by a quarter point? Why are they so afraid of raising rates by a quarter point? Why is it that a quarter point increase is going to derail the U.S. stock market? So when you take a look at this breakdown below, a key support level on the 10-year yield, and if it's true that the Federal Reserve has stopped buying bonds, then this is money. This is now a weekly chart. This is money that is floating into the bond market, forcing yields lower, which is great for the U.S. consumer. But one has to wonder why the Federal Reserve, with a 5% print on third quarter GDP, third revision, cannot raise rates. What is so wrong with this economy? What are they so afraid of? And it looks as though we're going to come back down. We're going to retest this lower band on the 10-year yield. As for the 30-year bond price, this isn't a massive bull run. In fact, we're going to see the 50-period moving average cross above the 200-period moving average. Very, very bullish event. The Dow Transports, a weekly chart. The Dow Transports is going to be my first chart to discuss the megaphone pattern. You may have heard about this pattern. I don't necessarily buy into it just yet. And I'll tell you why. It's because those who believe in the megaphone pattern are basing it upon the June lows through the lows seen back in October, where we were able to make higher highs and higher lows. It's a rare event. It really is. And you saw it in the transports. You saw it in the major averages. It's not supposed to happen, but it did. The markets rallied back, and we pulled back in November into mid-December, and we found a floor. And in this case, it's 8552 on the Dow Transports. Now, I use that level as my tripwire. As it stands right now, I believe that we are in an uptrend on the Dow Transports. Am I questioning the health of this rally? Absolutely. Do I believe that if we break down below this lower band of the rising uptrend channel, last tested on or during the week of October the 15th, do I think that we're going to break down and head down to this lower band of the megaphone formation? Absolutely. Note the downtrend on the Dow Transports. While you had a breakout on the weekly charts of the Dow Jones and on the S&P 500, you did not get that on the Dow Transports. That is a divergence back to the Dow Jones Industrial Average. Those Dow theorists out there, when you get a breakout on the Dow Jones, you would expect to see a breakout on the Dow Transports. It didn't happen on RSI. Is that a reason to get short? Not yet. The NASDAQ Composite, another megaphone chart. What are we using as our tripwire? 4,547. That's what we retested. Here's the lower band. Folks, if we break these support levels, you really need to think about either A, a cash strategy, or B, a short strategy, or a mixture of both. Either way, it needs to be a preservation of wealth strategy. Last week, we had a breakdown below our breakout point on RSI. We broke out here, rolled over, broke down once again, recaptured our breakout point. What happened last week? We broke that down once again. We're putting in short lower highs. This is a breakout point failure. I am not bullish on the NASDAQ. And while they may limp it up to all-time highs, it's going to be a dead man walking. Note the money flow, trending down, overlaid here in black. That's a divergence. S&P 500 weekly chart, another megaphone pattern. Our tripwire, 19,072.56. The S&P 500 must hold this support level. If it does not, we're heading a lot lower, to the lower band of the megaphone, in all probability. Will you have some support levels in between? Sure you will. You'll have support tested at 1900 or 1889 on the SPX. If it breaks, you're coming down here to the lower band. Note how we never broke out on the S&P 500 RSI as we did on the Dow Jones. Now we're testing the lower band of this pennant formation. And as with all the other major averages, we have been in a downtrend in RSI since 2013, November of 2013. And the list goes on, folks. The semiconductor sector. We had a breakout on RSI, very, very bullish. Here's our megaphone pattern. What must it hold? 52.32. You get a breakdown below there, you're going to 48. If it breaks down below there, in all probability, you're coming down to the lower band of the megaphone formation. Okay, the Russell 2000 or the IWM. I illustrated to my members how we had broken out above this upper band of resistance. And it was my expectation that the Russell 2000 would fully retrace all the gains seen of this breakout. And a retest would be healthy for the breakout. And we got it on the first day of trade of 2015. In fact, January the 2nd, 2015 was the worst first day of trade for a calendar year since 2008. So we were trading below this critical support level. We rallied back. I sent out an alert to members, beware. They're probably going to try to rally this market back. They're going to squeeze the shorts just as they did all throughout December. They squeezed the micro caps. They squeezed the small caps to give the illusion of a strong market rally, and they rallied off the lows of the day. If you see a breakdown below and a close below the key support level here at 119.13, look out below for the Russell 2000. But as it stands right now, the index has broken out. It has retested support, and it appears to be successfully holding for now. So net, I am a tentative bull on the market. I do not underestimate what the Federal Reserve can do to keep the markets primed higher. The markets could stay more irrational than we could stay solvent. So we need to have a foot in on the long side. But I think that in 2015, that the most profit that we're going to see is from a declining market. And what I'm going to be going over with the members on the market pulse check, which I'm going to be sending out later today, is the volatility index and what message it's sending us. I think it's going to be a volatile trading year. As our short trades in 2014 were our most profitable, and all of my calls are posted on my blog and on Stock, Twitch, and Twitter, so you can go back and check them. I think that the most profit that we're going to see in 2015 is going to be to the short side as well, only magnified because of all the divergences going on in the marketplace. So, folks, if you want to get alerted to these videos in the future, enter your email address. We hate spam too. You will not be spammed. If you're watching this on YouTube, please subscribe to my channel and leave a comment below. If you're watching this on Stock, Twitch, or Twitter, please follow me and you'll get alerted to these videos as well. Folks, have a profitable 2015. Enjoy the remainder of your weekend, and I'll talk to you soon. Be well.